Welcome to Breaking News to Trading Moves. Today we're zeroing in on a precise moment in the market where two extremely powerful forces collided. On one side, you had a massive technological success story. I mean, the confirmation of a major cloud deal between Amazon and OpenAI.
Right.
And on the other, you had this persistent reality of macroeconomic caution. You know, a dollar gaining strength and just this ongoing uncertainty about what the Federal Reserve is going to do with interest rates.
And that's the real tension here.
Our mission in this conversation is to carefully examine the material and clearly delineate the specific sectors, the specific companies that benefited immediately from that tech story, and then also those that saw pressure because of the macro environment.
Yeah, we're keeping this strictly factual, looking at the evidence and the tactical moves that came out of this divergence.
So the overarching theme that comes out of all this is really the continued dominance of a narrow market structure.
It is. Momentum is not evenly distributed at all. It's highly concentrated. It's driven by these specific tech catalysts.
Well, everyone else is sort of left behind.
Well, while broader market sectors have to continually fight against these pretty severe macroeconomic headwinds that, frankly, show no sign of letting up.
Okay, so let's begin with the trigger. The thing that really energized the technology side of the equation.
The central catalyst.
Exactly. The multi-year $38 billion Amazon Web Services AWS deal with OpenAI. I mean, that dollar figure alone is not just big.
No, not at all. It immediately tells the market that the foundation of this AI boom is and remains cloud infrastructure.
So the market reaction for Amazon, for ticker AMZN, was pretty much instant.
Oh, absolutely. The shares climbed over 4% right after the announcement. But, it's about more than just a single contract.
Right. It's not just about signing a new customer on the dotted line.
Exactly. It's a definitive proof point. It validates AWS as a core, a crucial platform for the most cutting-edge, mission-critical AI workloads being developed today.
So it really solidifies their position.
It absolutely does. It puts them right at the center as completely essential to the current stage of AI innovation.
Let's go a bit deeper on that $38 billion number, though. What does that actually mean in this context? Is it just a promise to spend, or is it something more concrete, like reserved capacity?
That's a key distinction the market is analyzing. A commitment of this size often translates into reserve capacity, which is extremely valuable for a cloud provider.
And why is that so valuable?
Well, for AWS, securing OpenAI, one of the largest consumers of compute on the planet, as a multi-year client, gives them tremendous forward visibility on revenue.
Okay, so it's not just usage on demand.
No, this is a guaranteed floor of high-margin compute consumption.
Which has to have an impact on how they plan their own spending, right? Their capital expenditures.
100%. Reserved capacity deals like this, they typically allow the cloud provider to optimize their own CapEx, on building out data centers, ordering high-end chips.
They can buy hardware with more certainty.
Exactly. Better certainty of long-term utilization, which can improve their return on invested capital and potentially boost the overall operating margins for the AWS segment.
Even with the heavy spending needed to build the infrastructure in the first place.
That's the point. This deal essentially de-risks a portion of AWS's future CapEx commitment because they know they have a guaranteed customer for that compute.
So if Amazon is winning a contract of this scale, what does that say about the competitive landscape? I'm thinking about Microsoft and Alphabet here.
Yeah.
Does this suggest a weakening of Microsoft's relationship with OpenAI, or does it just confirm that the scale of AI demands is so big it requires redundancy across all the major players?
It definitely confirms the latter. The scale required is just astronomical.
So Microsoft is still in the picture.
Oh, for sure. Microsoft, ticker MSFT, they maintain a deep, crucial partnership with OpenAI for specific software integrations and their equity investment. But this Amazon deal, it just highlights the sheer intensity of the compute demand.
So OpenAI's needs are just that vast.
So vast, they likely require infrastructure from all available hyperscalers, for redundancy, for geographical distribution, and just for supply stability.
But the market still sees it as a win for Amazon.
Of course, the market always views a deal like this as a competitive win, but it also reinforces the thesis for Microsoft and Alphabet, ticker GOOGL as well.
How so?
Because it confirms that their multi-billion-dollar CapEx investments into specialized data centers, networking, dedicated AI chips, like Google's TPUs or Microsoft's GPU clusters, it confirms all that spending is absolutely necessary and will yield massive revenue streams.
So the $38 billion isn't just Amazon's revenue.
No, it's the entire industry's validation. It validates that providing this foundational infrastructure is the most central and highest value activity in the market right now.
So, in essence, the investment thesis boils down to this. You can't build the fastest, most advanced AI models without these three primary cloud gatekeepers.
That's it.
And the money flowing into them is accelerating, no matter which specific large language model ends up winning the commercial adoption battle.
Precisely. We're seeing a continuation of the cloud arms race. And the size of this commitment, $38 billion, is a powerful statement on the capital intensity of training and running these state-of-the-art models.
It tells investors this isn't some fleeting trend.
Not at all. It confirms that this cycle requires sustained, high-dollar commitments that only massive corporations can fulfill. For anyone investing in technology, this deal provided immediate clarity on where the capital is flowing, straight into the foundational infrastructure provided by the cloud triumvirate.
Okay, so we've established the cloud providers as the essential platforms, the landlords, so to speak. Now let's move on to the critical suppliers, the companies providing the machinery and the applications that run on that cloud foundation. We have to look at the winners within the direct AI ecosystem itself.
Right, because the foundational requirement of the whole AI cycle is compute power.
And that always leads back to one place.
It leads directly back to semiconductors. The demand for specialized chips is just insatiable, and that's what keeps companies like Nvidia, ticker NVDA, in the spotlight.
And Nvidia continues to see gains. Can you elaborate a bit on the specifics of why they're maintaining this dominance, especially given what a deal like the Amazon OpenAI one implies about the build-out?
Nvidia's strength really lies in its ecosystem dominance and, of course, the superior performance of its high-end GPUs, specifically the A100 and the newer H100 lines.
It's not just any chip that can do this work.
No, the market is distinguishing very sharply between general-purpose computing and AI-specific workloads. AI models, especially training these massive foundation models, you need thousands of these specialized chips running in parallel.
And there was another element mentioned for NVIDIA.
Yeah, the material also highlighted that NVIDIA's gains are sustained by this focus coming out of Washington to prioritize its top AI chips for domestic use.
And that's crucial because...
It's crucial because it suggests regulatory support and, maybe more importantly, it underscores the supply constraints. If governments are prioritizing domestic access to each 100 chips, it means the global supply is exceptionally tight.
Which gives them pricing power.
Pricing power and sustained, concentrated demand for their processors. It suggests to the market that the barriers to entry for competitors are still very, very high at the top end of AI compute.
Okay, so the demand signal is clear. But if $38 billion is going into cloud infrastructure, this must also translate into opportunity for other semiconductor players, right?
Oh, absolutely.
People looking to challenge NVIDIA or provide alternative solutions.
Absolutely. And the market is watching other key players very closely. Advanced micro devices, ticker AMD, is a prime example.
What are investors looking for from them?
They are highly focused on their upcoming earnings report. It's a crucial barometer for the success of their specialized AI accelerator chips, like the MI300 series.
So they're positioned as the main alternative.
They are. They're positioned as the primary alternative supplier for large data centers that are seeking to diversify their chip sourcing away from a single provider. Their ability to deliver competitive performance at scale is a huge factor in the next stage of this cloud arms race.
And what about a company like Qualcomm?
Similarly, Qualcomm, ticker QCOM, is being flagged. Now, they may not be competing as aggressively in the data center training race as AMD or Nvidia.
So what's their angle?
Qualcomm is strategically positioned for the growing trend of edge AI.
Meaning running AI on devices themselves.
Exactly. Running smaller, more efficient AI models directly on devices like smartphones and laptops. The investor view here is that AI spending won't just stop at the data center. It will permeate the consumer device market.
Making QCOM an essential infrastructure play for that next phase.
That's the idea.
So, to summarize the investor view on hardware, it really is the classic picks and shovels trade.
It is.
You're providing the foundational tools, which is guaranteed revenue, regardless of which specific software application ends up capturing the most market share.
That view remains very firm. The $38 billion committed by OpenAI is an immediate requirement for silicon, whether it's the specialized GPUs for training, powerful CPUs for data pre-processing, or, specialized networking components to link thousands of chips together.
The demand funnel starts with the cloud providers buying this hardware.
It does. And this continuous, extremely high volume requirement supports the concentrated valuations of these infrastructure tech companies and makes them crucial winners in this market moment.
Now we move up the technology stack. We're going to the software and data platforms that actually generate revenue by using all that cloud compute power.
Right.
This layer needs to provide the validation that this massive infrastructure spending is translating into real commercial uptake.
This is where we look for the monetization proof points. Palantir, ticker PLTR, provided a strong indicator here. The company's shares rose after providing forward guidance toward stronger revenue.
And that's a vital moment.
It is, because the market is testing the AI thesis. Is this massive cloud and hardware investment generating real, measurable demand for AI software solutions that businesses and governments can actually implement for immediate returns?
So Palantir's performance isn't just about their specific product. It's a validation that enterprises are moving beyond just experimenting.
Exactly. They're actually writing checks for deployed AI applications. Palantir operates at the application layer, focusing on using AI and machine learning to solve highly complex, often bespoke operational problems.
So strong revenue guidance from them suggests CIOs are opening up their wallets.
It suggests their willingness to invest in customized AI applications is increasing rapidly. It confirms that the money is flowing from the infrastructure build-out to application consumption.
And what about the data platforms like Snowflake?
Yeah, so we also look at data platforms like Snowflake, ticker SNOW. They operate a little differently. Snowflake is positioned as the cloud-native data warehouse solution.
So they benefit because AI needs data, a lot of it.
A lot of clean, accessible data. That's what AI models thrive on. So if enterprises continue the necessary migration of more analytics and AI workloads onto the cloud, Snowflake provides the underlying architecture to store, govern, and make that data available to machine learning models at scale.
And how does Snowflake specifically monetize this trend beyond just storing the data?
Their revenue model is consumption-based. So as customers run more machine learning training and inference on their data within Snowflake's platform, the consumption of compute hours just skyrockets.
Okay.
So Snowflake benefits because they're monetizing the movement, the preparation, and the utilization of data for AI. They become an essential partner for companies looking to leverage data intelligence without having to build and manage all that underlying infrastructure themselves.
So this means these winners, PLTR and SNOW, they represent the two-pronged monetization side of the AI investment thesis.
They do. One is focused on the application layer, which is Palantir, proving that actual AI solutions are being bought and deployed.
And the other?
The other is focused on the data layer, which is Snowflake, proving that enterprises are moving the necessary data foundation into the cloud environment required for modern AI utilization. They demonstrate precisely where the software spend is flowing once the foundational infrastructure from Amazon and the chips from Nvidia are in place.
We've thoroughly covered the technological success story. Now let's execute a necessary pivot.
Okay.
While tech was basking in this focused AI momentum, broader, persistent macroeconomic forces created substantial headwinds for wide swaths of the market. Let's look at the immediate losers, starting with the sheer strength of the US dollar.
Yeah, the currency movement here was undeniable and aggressive. The dollar index, the DXY, it pushed notably higher.
And that had an immediate knock-on effect.
It did. As a result, the euro concurrently dropped to its lowest level against the dollar since the beginning of August. This is a clear risk-off currency trade.
What specific mechanics drove traders to scale back their expectations for a Fed rate cut later this year, leading to this dollar appreciation?
The strength of the dollar is a direct reflection of monetary policy expectations relative to the rest of the world.
Right.
So in this period, the market received some readings, maybe signaling ongoing labor market resilience or inflation proving stickier than hoped, that led traders to rapidly reassess the likelihood of the Fed easing rates in December.
So the market priced in higher for longer.
Exactly. And when the market does that, the yield on dollar-denominated assets, like Treasury bills, it becomes comparatively more attractive globally. This arbitrage drives capital toward the dollar, strengthening the currency.
And that tightening of expectations immediately generates pressure on companies that rely heavily on international sales.
A major headwind. The currency translation becomes a real problem.
Okay, let's break down that pressure on large exporters and consumer multinationals. You mentioned two core mechanisms, translation risk and pricing pressure. Can we detail those for clarity?
Certainly. Let's start with translation risk. Imagine a U.S. multinational like Procter & Gamble, ticker PG.
Okay.
They sell goods in Europe, denominated in euros. When P&G reports its quarterly earnings back in U.S. dollars, they have to convert those euro sales.
And if the euro has dropped?
If the euro has dropped against the dollar, those overseas sales translate back into fewer U.S. dollars. For instance, if the euro drops 4%, that multinational effectively loses 4% of the dollar value on every euro sale, even if the actual physical volume of goods sold remain perfectly steady.
So it mechanically reduces their reported net income.
It does. Performance on the ground can be perfectly fine, but the financials just look worse because of the currency conversion.
And the second factor was pricing pressure.
Right. So for a foreign customer who's using the euro, a strong dollar means U.S. goods are now effectively more expensive in their local currency.
Okay, that makes sense.
So if Caterpillar, ticker CAT, sells heavy equipment, a farmer in Brazil or a construction company in Germany now needs to spend more of their local currency to buy that dollar-denominated equipment.
And that can depress demand.
It can lead to lower international demand and declining sales volume in foreign markets, which exacerbates the overall negative impact on their reported earnings.
And the materials specifically point to some companies with heavy international footprints that felt this acute dollar pain.
Yes. Caterpillar, Deere & Company, ticker DE, and Procter & Gamble were cited as clear examples.
Because they're just so global.
These are businesses with sprawling, multi-billion-dollar international operations. They rely heavily on favorable exchange rates to convert that foreign revenue back into U.S. dollars. A strong dollar, driven by these revised Fed expectations, it acts almost like a guaranteed tax on their foreign earnings.
And it reduces their competitiveness at the same time.
It does. This exposure to currency volatility is a persistent drag until either the dollar retreats or the Fed provides more dovish guidance.
The shifting perception of U.S. interest rates didn't just bolster the dollar, it also created a distinct set of losers in sectors that are traditionally valued for stability and yield.
Yes, the market immediately repriced assets that are tied to fixed income.
And what triggered that?
That repricing was triggered by the movement in Treasury yields. They edged higher because the market grew less certain about a December rate cut.
And when the baseline return on risk-free assets goes up?
It changes the entire investment calculus for other asset classes. When you can get a better return on a U.S. government bond, it just changes everything.
And this brings us back to the idea of bond proxies. We should elaborate on the mechanics of why utilities and REITs get hit so hard when yields increase.
Sure. When we talk about these yield plays, we really need to focus on two areas: valuation and capital structure.
Okay.
So bond proxies like utilities and real estate investment trusts, REITs, they're structured to offer predictable, stable cash flows. And that traditionally makes their dividends highly appealing when other fixed income yields are low.
But when Treasury yields increase, the valuation argument suffers.
Severely. First, the relative attractiveness of the dividend diminishes. If a 10-year Treasury bond now offers, say, 4.5% risk-free, the equity risk you take on with a utility or a commercial real estate trust.
Even one with a slightly higher dividend.
Exactly. Even one with a 4.8% dividend, it suddenly looks less palatable. Investors rotate out of that equity risk and into the safety of fixed income.
And the second point you mentioned, capital structure, is perhaps even more critical for these sectors, isn't it?
It is essential. Utilities and REITs are inherently leverage-heavy businesses. Utilities require massive ongoing CapEx to maintain and upgrade infrastructure, think power lines, renewable energy projects, which is all funded by debt.
And REITs are similar.
REITs, like Prologis, ticker PLD, are built on acquiring and holding properties, primarily funded by low-cost debt.
So when interest rates rise, their cost of debt just spikes.
It does, especially as they need to refinance maturing debt or seek new capital for that CapEx. For a utility like NextEra Energy, ticker NEE, a sustained period of higher rates increases their operating costs and it reduces the profitability of new long-term projects.
And for a REIT like Realty Income?
For a REIT like Realty Income, ticker O, higher debt costs compress their net operating income. It also negatively impacts the capitalization rate, or cap rate, which is a primary valuation metric in real estate. Higher cap rates mean lower property values.
So the pressure on companies like NextEra Energy and Duke Energy, which is ticker DUK, it stems from that dual hit. Rising debt costs compromise their massive capex needs, while at the same time their dividend yields become less competitive.
Precisely. The material highlighted these key names because they embody this sensitivity. For the REITs, we saw pressure on Realty Income and Prologis. These companies are valued on the present value of future cash flows.
And when the discount rate goes up?
When the discount rate, which is tied directly to prevailing interest rates, rises, the mathematical present value of those long-dated cash flows declines, and that forces their stock prices down. This divergence in interest rate expectations created immediate sellers in these rate-sensitive yield plays.
Finally, we turn to the assets positioned at the far end of the risk spectrum, cryptocurrencies and the equities associated with them.
Right.
Here, the combined pressures of a strengthening dollar and a tightening of overall risk appetite created a distinct cooling effect.
Yeah, the specific movement noted was a pullback in Bitcoin, which slipped about 2 to 3% on the session. Now, that might seem minor, but in the context of a strong dollar rally, it's highly illustrative of capital flows.
What does this show?
When the dollar strengthens because of perceived central bank tightening or just global uncertainty, capital tends to flow away from speculative, non-yielding assets like Bitcoin.
And it flows into the perceived safety and higher yields of dollar assets?
Exactly. This is the classic risk-off environment manifesting directly in digital assets.
So how does that relatively modest Bitcoin movement then amplify into meaningful underperformance for the listed companies in the crypto sphere?
This is where the concept of leverage becomes critical. Listed crypto proxies are equities whose valuation or business model is heavily tethered to the price movements of Bitcoin or other digital tokens.
So they act like leveraged bets on the underlying asset.
They do. They amplify both the gains and the losses.
Let me give an example.
Consider MicroStrategy, ticker MSTR. Its primary corporate strategy involves issuing debt to acquire and hold large amounts of Bitcoin. Because its balance sheet is leveraged to the token, any drop in the Bitcoin price reduces the value of their core asset, while the debt obligation remains fixed.
So that makes them extremely sensitive to even minor movements.
Extremely. It causes its equity price to pull back a lot more than the token itself when the dollar strengthens and risk appetite fades.
And for a company like Coinbase Global, ticker COIN, the big exchange operator, how does this environment impact their business model?
Coinbase's revenue is predominantly driven by trading volume and transaction fees. So a risk-off environment, signaled by a stronger dollar and lower Bitcoin prices, typically leads to decreased speculative trading activity.
And less volatility.
Less volatility. Less volatility and lower prices mean lower transaction volumes across the entire ecosystem, which directly hits Coinbase's top-line revenue potential.
So MSTR is a leveraged asset play, while Coin is a revenue exposure play.
And both suffer disproportionately when macro risk aversion settles in. Therefore, the combination of a weaker Bitcoin price and a strengthening dollar signals a broad retreat of speculative enthusiasm, which translates directly into outsized underperformance for these related risk-sensitive equities.
Okay, let's summarize the market structure revealed in this material. We observed two highly effective opposing forces, concentrated technological momentum driven by that colossal Amazon OpenAI deal versus the unrelenting pressure of macroeconomic caution evidenced by the rising dollar and firming treasury yields.
This market moment really illustrates the tactical challenge presented by a narrow market. Technological execution, specifically the real-world deployment and massive commitment of capital to AI, provides sufficient momentum to keep specific infrastructure and software companies buoyant.
But that momentum isn't broad enough to lift the entire market.
No, which means exporters, yield-focused stocks, and crypto-related names continue to face severe resistance from macro realities that are just outside of their control.
And this divergence led to a very clear tactical observation for market participants based on the material we reviewed.
Yes, the tactical observation was to capitalize on this specific divergence, leaning into AI strength on the long side, the hardware and software infrastructure, while identifying tactical opportunities in dollar-sensitive and rate-sensitive areas on the short side.
And maintaining that posture for how long?
Maintaining that posture until the macro environment provides definite clarity on the Federal Reserve's future rate path. The market is rewarding clarity and punishing macro exposure.
The knowledge gained here is valuable, but what is the single most important lesson for the person listening right now?
The crucial takeaway is recognizing the limits of technological euphoria. Even the most powerful technological breakthroughs, like the AI revolution confirmed by that $38 billion commitment, cannot entirely insulate the broader market from underlying currency and interest rate dynamics. The challenge is continually assessing whether a sector's technological momentum is strong enough to fully overcome its built-in exposure to macro pressures, or if it is destined to languish until those macro winds finally turn.
Please remember, the material discussed here is purely the opinion of the author of the provided analysis. This is not financial advice, nor is it a recommendation to buy or sell any security. Always conduct your own diligence.